Good morning. Welcome to Trading Hour here on CNBC TV 18. Contrary to a lot of expectations of the Nifty hitting 25,000 earlier in the day, we are seeing a bit of red on the screen in today's session, which is, of course, the final trading day of the week. That the bulls are fighting to hold on to some of the weekly gains that the index has made so far in this week. 24,660 is where we are. The important level on the downside, though, of course, is going to be yesterday's low, which was around 24,500, from where the Nifty had reversed and then had that 300-point recovery from the lows of the day. But as the benchmark is holding on to some bit of losses, the losses are not as extreme, and that is because of IT, and Infosys is the one that is leading the pack. The ADR was 8% higher, not quite the rub-off that you are seeing on the Indian listed entity. The stock is just around 2.5% higher as we speak. The brokerage commentary was fairly positive as well. Price target hikes coming across the board. Ratings are more or less left the same. So Infosys now above 1800, 3% higher. But the broader market screen is showing a bit of pain this morning, and the mid caps and the small cap indices are the one that are trading with significant losses, and they have been underperformers almost through the week, and that has been the case for the broader markets. The small cap index is down over 2%, the mid cap index is down 2% as well. And if you can pull up some of the earnings reactions as well, and you would see the kind of moves that these stocks have seen in the broader markets. JSW Infra, the numbers were a bit of a miss on expectations, 6.5% lower. The top loser on the mid-cap index as we speak, 313 now on JSW Infra, 6.5% lower. Persistent Systems is the other one. We'll have the management speaking to us later in the day, but that stock too down 6% after the margin miss that the company reported, and there are also concerns with regards to the margins. Now almost 6% lower as well is Persistent Systems. Now there was a bit of a recovery from the lows of the day, but that has got swiftly sold into as well. Some of the other earnings reactions, Dalmia Bharat as well. The numbers were okay as far as what Nigel was highlighting, but the stock down 5% as well. Dixon Technologies continues to see some bit of correction, and of course some of the defense names that have been in focus after the downgrades that have come in from Nirmal Bang earlier this morning. HAL, Bharat Dynamics is down almost 5%. So BHEL is also trading with losses of around 4%. So sell-off continuing in the PSUs. The index trading with small bit of losses. The broader markets are seeing a bit of pain in today's session. Time to say hi to Reema Tendulkar.
Hi, Hormus. It's a little scary looking screen, right? When you look at the broader markets, you look at the advanced decline ratio and the way you are seeing, the mid caps and small caps capitulate. But we've got a management waiting by. South Indian Bank, and those shares are up nearly 3%. The net profit is up 45%. Deposits have seen an 8.5% year-on-year growth. We have with us PR Seshadri, the MD and CEO of the bank, joining in. Thank you very much, sir, for joining in. While there's a big jump in the net profits, as we pointed out, the stock is doing well. There's one number which is a bit concerning, and that's the increase we've seen in the slippages. Quarter on quarter, your slippages have gone up 20% and stand closer to 350. What led to that? What were the big accounts, which went bad this time? And what can you guide on slippages going forward?
Thank you very much for having me on the show. Slippages, we seem to have a cyclicality in slippages. So when I look back in history, I find that the first quarter tends to have slightly higher slippages than other quarters. And in this quarter, whilst it was low, slippages were lower than first quarter of the prior year, they were still higher sequentially from the prior quarter. We had no single large ticket loan slipping, so no corporate slippage during the quarter. Most of the slippage was on the small business and agriculture side. So there's nothing material to report. I mean, in the sense that we think that this is business as usual. It's just a little bit of seasonality playing through. Recoveries continued to be reasonably strong. We came in at about 309 crores of recoveries. So slippages did exceed recoveries for the first time in some time. But having said that, we think that the situation should correct and reverse itself as we go forward.
Right. Mr. Seshadri, good morning. Thank you for joining in. And you mentioned that some of the stress came in from the smaller businesses and the agri side. Do you see that as a trend that is likely to persist, considering the monsoons have just begun now and there might be some recovery going forward? You mentioned about seasonality as well. Do you expect that slippage number to recover as FY25 goes by? And what you can guide on the asset quality as well, because that was flat compared to the March quarter. So do you see that number trending down as well?
From an asset quality perspective, if I may answer the second question first, asset quality perspective, we think that the trend that we've been displaying over the last year, year and a half will continue. And we think that both gross as well as net NPA numbers should continue to go downwards. And we are hoping that we are closer to the 1% mark, maybe 1.1, 1.15 at that level on the net NPA number by the end of this financial year. With respect to slippages by themselves, I don't see any trends here. It's just that Q1 for us tends to be the quarter with the highest slippage, and that seems to be seasonality that we have demonstrated over the years. And that's essentially because of the nature of how this organization works. And we think that as we go forward, slippage numbers should moderate back to the levels that we normally see. Therefore, we are not at this juncture concerned in any business line to say that there's any form of trend that is emerging, actually.
Okay. When you say slippages should get back to normal levels, we're talking about 300 on a quarterly basis. And also, if you could give us that number there. And also on margins, we've seen a drop in your net interest margins quarter on quarter, year on year. What's the outlook on NIMs?
Again, answering the second question first, NIMs, we were at 3.26% or thereabouts for the quarter. We are, managing NIMs on two fronts. One is by ensuring that our cost of borrowing remains reasonable. So our quarter-on-quarter sequential increase in cost of funds was only six basis points. So I think we are doing a fairly good job there. And we are trying to increase our NIMs by ensuring that we change the product mix on the asset side. So we're currently approximately 42% of our book is corporate, and we are trying to change that mix to bring that down to about a third and get higher yielding assets, both from MSME as well as retail, to take the slack as a consequence. So if you're able to do that, we think the NIMs will actually widen from where we are today. But that process will take time. And we are hoping that in the medium term, we can get this to about 3.5 or thereabouts.
Right. Mr. Seshadri, I wanted to speak to you about your deposits. They were up around 8.4% year on year and around about 1.5% sequentially. In normal terms, you'd consider that as slightly weak. And you're also hearing reports of a lot of people, the deposit withdrawals coming in to be put into the equity markets. Of course, this is all reports that are being circulated. But what are the steps that you're taking to mobilize more deposits, especially considering that there is so much competition out there? And you might want to say that your depositor is almost spoilt for choice. So what steps are you taking to ensure that that deposit growth figure returns to double digits, or are planning on doing so?
From a deposit perspective, actually, we had a very, very good quarter. Our CASA balances on a sequential quarter-on-quarter basis grew approximately 6%. These are average balances. So I think we are an outlier when it comes to CASA balance growth. What we are doing is we are increasing engagement with our customers. We do have approximately 8 million customers. And at the branch level, we are trying to ensure that we engage with them as intensively as possible. And that's beginning to pay off for us. On retail deposits, given the fact that our asset growth, we've been ensuring that we are in the 10 to 12% range. We really don't need more deposits, so we are ensuring that our price control on the deposits is very, very tight. So as of today, we are priced actually significantly lower than some of our larger peers in this market and still growing at 8%. So we think that we have a solid deposit franchise, and were we to require more deposits, we think that we can bring it in. And I think we've demonstrated that on the CASA front. There has been very substantial growth on CASA, which we're feeling really good about.
One final question, Mr. Seshadri, and your loan growth has remained healthy, if I can say that, around about 11%, if I'm not wrong. Yeah, 11% year on year. What's your outlook on the loan growth going forward? And if I can ask you, are you being slightly conservative when it comes to growth? And what's your outlook on the loan growth front for the rest of the year?
So we've been telling people that we want to grow between 10 and 12% for the year. Our challenge is not in growing the book. Our challenge is in rebalancing the book. So that we can grow our NIMs. So from our strategic perspective at this point in time, our focus is more on profitability and ensuring that we can get greater revenues for the same balance sheet size and for the same amount of risk that we are running. And therefore, we are prioritizing the change in the balance sheet mix over growth. So that, consequently, we wish to grow between 10 and 12% for the year, which is where we think we have a sweet spot from a liability pricing perspective.
All right, Mr. Seshadri, we leave it at that. Thanks a lot for joining in, sharing with us your outlook on the road ahead for FY25. Wish you good luck for the rest of the year as well. That was the management of South Indian Bank. Pretty confident about the road going ahead. The stock also doing well for itself, was up 3.5% when we last spoke of. And so a good reaction to the earnings coming in there for South Indian Bank. But time for a short break here on Trading Hour. Up next, Reliance Industries is expected to report its first quarter numbers later this evening. We'll get you all the key expectations on the other side. Stay tuned. Welcome back to Trading Hour. The broader markets are witnessing some significant selling pressure right now. 90 stocks on the mid-cap index are trading with losses and 91 on the small-cap index are trading with losses as well. Almost 2,000 stocks on the NSE are currently trading lower compared to just 320 that are advancing. The Nifty Metals Index is the one that is leading the losses, though almost 2.75% lower as we speak. All 15 stocks on the index are trading lower. NMDC is leading the charge there on the downside. NMDC, SAIL, Ratnamani Metals, all of them are trading with significant losses of anywhere between 3 to 4% as we speak. And the pain in the broader in the small cap index has intensified as well. MCX is down 6%, and that stock had seen a 5-day gaining streak before today's fall. So it's witnessing some bit of profit booking from higher levels is MCX, 6% lower there. Also not doing well in today's session is CIE Automotive, which was earlier Mahindra CIE, of course, and that is a result reaction, 5% lower there as well, almost 580, slightly off the lows of the day, but still trading 4.5% lower. But the focus today is on the big boy, and that is Reliance Industries, which is expected to report its results later this evening. The street is looking at a modest rise in EBITDA on a year-on-year basis. Now, Sonia is joining in with a detailed rundown of the earnings preview. Sonia, over to you.
Well, thanks a lot for that. First, let's look at the stock performance. In the past 6 months, the Reliance stock is up almost about 15% at 3150. Currently, it's had a strong run in the past 6 months. Let's take a look at the numbers as well. On the revenue front, year on year, we're expecting an improvement to 2.3 lakh crores versus 2.07 lakh crores same time last year. The EBITDA is expected to rise to 39,845 crores versus 38,100 crores same time last year. And the profits are expected to rise to 18,432 crores versus 16,000 crores same time last year. Now, what can you expect this time around? The consolidated EBITDA will see a marginal growth year on year. However, sequentially, we are expecting a weaker growth on the back of lower gross refining margins and muted growth in the Jio and retail business. Jio is expected to see stable average revenue per users and 9.3 million overall net additions versus 11 million quarter on quarter. Even the average revenue per user is seen flattish at 182 versus 181.7 last quarter. Now, we can expect a modest 2% quarter-on-quarter EBITDA growth on increased store footprint and operating leverage in the retail business. So, yes, it will be quiet in terms of a sequential performance for the retail and telecom business, but on a year-on-year basis, we are expecting a decent improvement.
Sonia, thanks a lot for that update. Now, a key driver of the growth for Reliance in the last few quarters has been the retail business. So what are the expectations from there? Mangalam is joining in with a lowdown on that. Mangalam.
Reliance Retail, the growth driver of the business, likely to drive growth this time around as well. But the only important thing to watch out for would be the impact of the general elections and the massive heat wave on consumer sentiment itself. But nevertheless, because the company has been expanding its store footprint and footfalls are increasing, that would aid growth, and the EBITDA margin would be impacted positively by operating leverage itself. So year on year, Kotak estimates a near 11% growth in the top line of the retail business, around 77,700 crores in terms of this quarter's revenue, and the EBITDA grows a shade higher at around 11.5%. The number you're looking at is close to 5,750 crores. What it means is that the margins would show a slight improvement closer to 7.5%. But remember, this is the first quarter of FY25. FY24 was a record-breaking year as well, where the retail business revenue crossed 3 lakh crore, the profits crossed about 10,000 crores, and the overall retail store footprint also moved near 80 million square feet. Importantly, the company launched a couple of new formats as well. They are among the top 25 retailers of the world. And remember, their stated policy is to be among the top 10 retailers of the world as well. So how do these new formats, the likes of Tira, Yousta and Swadesh, pan out in FY25 is something that we'll be watching out for. And more importantly, the most important trigger of demerging or value unlocking in the retail business by separate listing is something that would move the stock too.
Mangalam, thanks a lot for that update. And Reliance Industries currently trading with some losses in today's session. It's seen a good up move in the last 1 month. Ahead of earnings, the stock was up almost 7% in the last 1 month, currently trading 1.5% lower at 31.30. But time for a short break here on Trading Hour. Up next, we discuss market technicals. Mitesh Thakkar joins in on the other side and also shares with him his top trading bets.
All right, well, as a bit of a change of guard, I'm here in place of Reema. The market, of course, continues to reel under pressure. That's been the big headline, and there's no let-up in that selling. Look at that, 145 down on the Nifty, and the mid-cap screen is bleeding almost 1,200 points now. So some, cool-off profit-taking definitely underway. Mitesh is with us, so let's get some ideas going. Mitesh, what do you make of today's decline, and what would the trades be? Are you, betting on anything on the way down? Mitesh, I think, yeah, we can hear you now.
Yeah, I think the index, we called for some correction, saying that early in the 10 o'clock show, I suggested that even if people haven't exited, I think good time to exit, because now the hourly and the 2 hourly charts are looking negative, and I think there could be a slightly bigger pullback. It looks to be playing out that way. 24, 530, 550 is the first support zone. And below that, in the worst case scenario, I think 24, 400, 350 zones could be tested. So some more pullback can happen. Therefore, looking at some shorting opportunities, particularly in the metals name. So I think that's where some kind of weakness is arising. Look at Tata Steel, that's a sell. Keep a stop at about 164.5 and look for targets of 152, 151 on the downside. And the other stock is RP Industries. I think that's also turning negative. So sell here with a stop at about 700 for targets of 650.
Mitesh, thanks a lot for joining in, sharing with us your views on the index and your top trades as well. By the way, pull up Paytm, and that stock has recovered from the lows of the day after it reported its first quarter results. The losses, though, have widened on a year-on-year basis. The loss now at 839 crore for the June quarter compared to a loss of 357 crore it reported in the same period last year. Some flashes on your screen as well with regards to their earnings call, where the management has spoken about the fact that their revenue and profitability is expected to improve going forward. And I guess that is somehow rubbing off on the stock as well, recovered from the lows of the day. And they are awaiting approvals as well to start onboarding of the new UPI users. There's a lot of hype on that Paytm IPO. I remember 2150 the IPO price. It's still not seen those levels. It's now almost struggling at around 450. But some optimism being shown by the management after all the RBI action and all the scrutiny that has taken place all through the year.
It's been a roller coaster and more down than up for the Paytm shareholders, especially the ones who got in at the IPO time. That's one stock. Looking at some others, let's check out where the pressure is in the broader market, because as we're talking about it, it's really a mid-cap led fall and the number of declining stocks is now over 2,000. So where is the money coming off? Some of the tire names like JK Tyre are under pressure. Then, of course, the entire metals complex, PSU, non-PSU. Metals is a down space. I guess that has to do with the fact that globally markets are in a risk-off mode. Look at something like SAIL or NALCO. On the large cap screen, we were talking about JSW Steel, Tata Steel, all those stocks were also down. So metals definitely on the lower side. Manappuram is losing about 3.5% on good volumes. So these are some of the major names on the way down. Lemon Tree Hotels, is another one. IRB Infra, L&T Finance. So these are the pockets where there's price and volume action on the way down. Besides that, just some more names. I mean, look at the fall on Cummins now. 5% down on Cummins. Persistent continuing to react to those numbers, down about 6.5%. Jupiter Wagons is a long list. Amber is down about 5% as well. So mid-caps really reeling under the pressure.
Real estate is another pocket that is the biggest sectoral loser today. 3% down now on the Realty Index. All 10 constituents trading with losses as we speak. Macrotech is the top loser on the index. They're 4% lower now on Macrotech. Oberoi Realty numbers come out later this evening, so 3.5% lower there as well on Oberoi Realty. Almost 4 stocks trading with losses of between 3 to 4%. Soba, Phoenix Mills, DLF, Oberoi Realty, all of them trading with losses of anywhere between 3 to 4%. But time for a short break here on Trading Hour. Up next, we discuss the fundamentals of the market. Varun Locha of HDFC Securities joins us on the other side. Stay tuned. Back with us here on Trading Hour, the Nifty remains where it is, 150 points lower. The broader markets continue to struggle, but the Nifty is trying to be supported by Infosys and ITC, the two stocks that are ensuring that the Nifty downside at least is capped. Time for some market fundamentals now, and Varun Locha from HDFC Securities is joining us now. Varun, good morning. Thank you for joining in. In your very recent note, you have mentioned that risk reward is turning increasingly unattractive and you are advising to remain cautious on the road ahead. And now a lot of people would ask you that what should you be buying? But we'll flip the question a little and say, if you're saying that the risk reward is getting unattractive, which are the pockets where it is happening so?
Yeah, good morning. So, so in this recent note, we again highlighted that, there is a sort of euphoria or over optimism building in, especially in mid and small caps. But at the same time, even in a lot of large caps, we have seen significant re-rating and stocks trading ahead of fundamentals. So actually, I think more than the market cap, it's to do with certain segments. Obviously, industrials, cap goods, some of the PSU names, were more prominent in the list of names which are trading at significantly rich valuations. But again, when we say PSU, some of the really large PSUs with good free float, they are still trading at reasonable valuations. But a lot of the, low free float PSUs, more thematic sort of companies, they have significantly re-rated, and we believe risk reward is unattractive there. So, I think those are some of the pockets where there is clearly overvaluation sitting, whereas 2 or 3 pockets where valuations were relatively okay was one, banks, second was IT, especially large cap IT, and third was consumer staples, where relative to history and relative to rest of the market, these segments were looking slightly better from a risk reward perspective.
Varun, hi, good to have you on the show today. Just wondering whether Havells or Polycab, I mean, whether these stocks are under the coverage. Both are important mid-caps the market looks at and tracks widely, and both have missed expectations in the quarter gone by. Any thoughts here? And also sort of, single out for us any other important mid-caps in your portfolio where earnings have either come or something that you're really watching out for, important to watch mid-caps from your perspective.
Yeah. So Havells we do cover. We have an ad rating out there. Consumer discretionary, especially consumer durables, we have been positive in the last 3 to 6 months. So along with consumer staples, that's been one sector where we have turned more constructive in the past 3 to 6 months. Again, given the relative risk reward, and we believe that the demand conditions seem to be bottoming out even for consumer durables. But Havells had a very strong run from 1400 to 1900 within 3 to 6 months. So right now we don't have much upside left on our target price, but we have an ad rating. Polycab we don't cover. Crompton Consumer is another consumer durable play where we are positive among the mid-cap names, and even Orient Electric. So consumer durables as a space, we are positive. Consumer staples, as I said, we are positive. So names like, Marico, Britannia, Dabur, which are actually large caps, but the second rung large caps after ITC and HUL. That's the segment which we are positive on. As I said, looking more at certain pockets and certain sectors, not, again, in IT, mid-cap IT is something which we have not been too positive on off late, but large cap IT we believe offers better risk reward, and therefore we have been shifting more towards that side in the last 3 to 6 months. So it's very sector specific.
Interesting you brought up IT. I was going to ask you just that, whether the excitement has already been captured in the stock price. I mean, the rally started building just before the numbers, right? TCS, Infosys, most of these stocks were up. What are your top picks, and whether you still think that there is more headroom left after the Q1 performance?
Yeah, so you're right that a part of the upside has already been captured, because you have to keep in mind that it's not that we have seen significant improvement in in the demand conditions in IT, just that we are now seeing clear signs of things bottoming out, which was looking like the case 2 quarters back as well. But then we had a scare in between after Q3, Q4 numbers, and now we seem to be again getting a sense that things are bottoming out. But if you look at the growth for even next year, still FY25 and 26, the sector is not going to do anything more than 8 to 10% on earning growth levels, which means after this 20-25% kind of run up which we have seen in last 1 month in some of the even large cap IT names, the absolute upside looks limited, but at the same time, with improving demand conditions, the downside also looks fairly limited in case of IT, given the quality of businesses, the cash flow they throw, and the valuations at which they are trading at. Some of the large cap ITs are trading at more like 20 to 25 times 1 year forward PE. So I think absolute upside, we might have captured 60 to 70% of that within the last 1 to 2 months. But I think still it's a sector which is looking fine on a relative basis when we look at overall market, because there is a lot of overvaluation sitting in other pockets compared to IT.
Varun, you spoke of PSUs. I wanted to zero in on that a little, and you spoke particularly about the defense PSUs. And one of the stocks that you have highlighted in your report also is HAL. And not to talk, you may want to talk HAL specific, but the entire defense theme as a whole, they've seen a kind of run up which is, it's hard to justify, because stocks are up almost 200-300% in just the first 7 months of the year. And he recently had a domestic brokerage also downgrading these names, saying that even at the most aggressive earnings estimates, it's still very difficult to justify the valuations that they are at in. Would you rate the defense as one of those sectors where people should look to take money off the table? Because of course there is plenty of money already made, but over a longer term perspective, what's your call there?
So won't be able to talk on HAL specific, given we don't have a rating on the stock. But on the defense sector, and what we have highlighted in the note is a whole host of stocks where we have not seen meaningful earning upgrades, but the stocks have ran very hard in the last 6 month, 12 month, 18 month period, and where valuations are now significantly above long-term averages. Even if we were to ignore long-term averages, some of these stocks are trading at 40 to 50 times P, which seems fairly high, even if we have a long runway of growth, because there are going to be execution slippages. The margin profile of these companies is volatile and changes, from order to order. So it's difficult to forecast a very long-term sort of a picture, while they are going to compound at probably 10 to 15%, given the way defense spending is expected to continue to remain healthy. But we believe a lot of those positives and next several years of growth is already built in. So so what we are advising is caution on some of these segments. Railways is probably another such segment where we have seen significant re-rating and a lot of stocks trading at 40, 50, 60 P. Despite the long runway of growth, we believe at those valuations, once you buy, the probability of making sizable returns in the future gets diminished. So with that perspective, we are advising caution on some of these segments.
All right, got it. Good talking to you, Varun, today. Thanks very much. You have a good day and a good weekend, and we look forward to connecting again soon. Need to take a break. When we come back, an interesting discussion lined up. Jyoti Gupta of Nirmal Bang Institutional Equities is going to be joining in Nirmal Bang has recently taken a very guarded call on the defense space. They have downgraded the sector, saying valuations are too high. We will get into that conversation in just a minute. Welcome back. The cool-off continues in the market. The sector on which we will now train the spotlight is going to be defense. Now, Nirmal Bang has come out with an update, and they have actually downgraded the defense sector in their first quarter earnings expectation note that they have put together, and they cite super rich valuations as the reason behind this. In fact, I'm looking at some of the ratings now. A lot of the stocks under their coverage are now either accumulate or outright sell. For instance, Mazagon Dock has become a sell for them. Paras is a sell, and a couple of others as well. I think this is perhaps BHEL and a couple of others as well. They were quite bullish on Astra Microwave, but that seems to have now become an accumulate as well. So what's behind this new call after 3 months? Well, let's ask the guest who's joining us on the show. We have with us Jyoti Gupta of Nirmal Bang Institutional Equities. Jyoti, good to have you on. And I remember our conversation, right, when you came out with that initiation report about 3 months back. And we were discussing this at that time, that the story is well intact and yes, there's an opportunity and indigenization is happening, but our stock's getting overexcited. What has made you change your stance in 3 months?
Thank you, Surabhi, for having me here. So actually, while we remain positive, the entire run-up that has come is based on positive sentiments and retail flows. While we remain structurally positive in the sector, we believe the valuations have run up far ahead of the fundamentals. And therefore, we advise caution. And if you look at my report, our valuations are based on 2 standard deviations mean and for most of the companies. And yet the companies currently are trading above these levels, which I believe to some extent may not be sustainable. That's the whole.
Jyoti, good morning. Thank you for joining in. I wanted to ask you off that as well, right? Because 3 months prior, most of these stocks had still had a very significant run. Say the likes of Mazagon Dock or Cochin Shipyard, the shipbuilders in particular, and now they've had an even bigger run. And you mentioned that most of this has been based on order book, the order book visibility. I was checking about some of these valuations as well, and most of them are way above their 5-year averages, even a few months prior as well. So, what has changed in these last 3 months that prompted you to change your stance? Because the stocks had moved previously as well.
So, I mean, mainly what I see is that, and that was my initial statement as well, was that what you see the run-up is based on order books, and it continues, to remain on the order book. I want to see execution. In fact, one of the reasons I'll cite, look at HAL, what has happened. Not that I am negative on HAL, or not that I'm saying that I have downgraded the sector. But I am still very positive on the companies, and we believe that, what we really need to see, the metrics are still not, factoring in cyclicality and efficiency, which is what is lacking. And that's the whole reason why I see, and my downgrade is purely based on valuations. I am still very, very structurally positive on the sector.
Fair. Please go ahead.
Now, what we see is still the order book. I'm not seeing much visibility on the execution side. I want the execution to at least pace, maybe let's say by the 4th quarter, and I will currently be on the sidelines and wait for that to happen.
Right. Fair enough. Jyoti, what I wanted to ask you was that now defense as a sector as a whole is a very long gestation period sector. You mentioned that you want to see more on the execution front, which is fair. And most of these orders that these companies are winning, recently Garden Reach won an order which was around 840 crores that was supposed to be executed by 2028, 2029. That execution period will take a while to materialize, right? So what does one do until then? Do you see that there is a much needed correction due in these names just because execution is a big risk which I guess, was also a big risk back then as well?
So basically, my numbers already have factored in all these, big, large order books. And when you talk of Garden Reach, frankly speaking, I think, and when what I understand as well, that most of the orders which Garden Reach will get will be executed by L&T. So just based on the order book, and see, gestation is definitely there. But beyond that, if there's, like, for example, in HAL, we were expecting that 6, which is in the news, that the 6 LCAs are supposed to be delivered. Now, even that looks a little, somewhere it looks delayed. That I feel should not happen in the case of other companies as well. So mainly, I mean, when it comes to order books, everything, our numbers are actually priced in. I don't see any surprises beyond these numbers right now.
Jyoti, finally to sum it up, I'm looking at the stocks where you have at least an accumulate rating. You don't have a buy on anything. You have an accumulate on Astra Micro, Bharat Dynamics, BEML, and Data Patterns. So what is the advice to people if someone is, trying to get in now and be in the defense sector for the long term? Then out of these stocks, which one looks like the best bet to you?
See, long term, I am positive on HAL. I continue to remain positive on HAL even today, while it is still sell right now. Reason is, again, if you have seen last 2 days, what has happened in HAL is even when I started, I said key things in HAL is your engines, your landing gears, which is, again, we're dependent on international companies. We need to build in capabilities domestically. And if that doesn't happen, these executions are going to get delayed, which is what we're seeing in the 6 LCAs, which is supposed to happen in FY 25. So, these timelines are very key to the defense sector. Second is, on BEL, while it is a sell, I am still positive on that, because again, this is, any order that comes to MDL, HAL, or BDL for that matter, all the electronic, equipments and all will be done by BEL. So while it is positive, but again, execution is what needs to pick up pace. We haven't really downgraded our earnings forecast. And the other thing which is very important is, if there is a change in US presidency where, the Republicans are less prone to defense spending compared to Democrats, and, they're more inward-looking policies, of course, that is going to impact the global defense spending as well. And the tighter budgets, again, are going to adversely affect the defense spending. So, there's so many things to it, and to the sector. So, while I'm positive on HAL, BEL again, but at present, at the current levels, I don't see, I think correction is really important in the sector.
Right. Execution is the key. Jyoti, thanks a lot for joining in, sharing with us your views on the sector as a whole. Jyoti Gupta of Nirmal Bang there on the defense sector. Time for a short break. More on the market and specific stocks on the other side. Stay tuned. Back with us on Trading Hour, and the indices continue to trade in the red as we speak, but Infosys has moved to the high point of the day, 3.2% higher now as we speak. We started off the show when the stock was around about 2 3/4% higher, so slightly building on those gains as well, and that is the stock that is lending some big support to the Nifty. But the losses have intensified in the metal sector. The Nifty Metals Index is now down 3.6% as we speak, the top sectoral loser. All 15 constituents of the index are now trading with losses on the metals index, are not good developments coming in from China, and that is weighing on the sector in a big way. And the realty index too has sold off even more now as the show has gone on. 3.5% lower there as well on the Nifty Realty Index. And that sector as well, all 10 constituents of that sector trading with losses. The mid-cap index is down 2.25%, as is the small-cap index. The auto index is down almost 2%. So barring FMCG, which is flat, and barring IT, which is courtesy Infosys, the screen is pretty much red.
Oh, yes, absolutely. I mean, it continues to be a fairly weak day, you'd have to say that. Let's look at some of the movers and shakers in terms of the mid-cap. So we've been talking about a lot of the losers. Can we spot any winners? VST Industries is one, 16% higher. There is, I think, also the expectation that there will be a bonus that the company could consider. I think there's along with the results meeting, and that's suddenly getting everybody very excited around VST. That's one. What else? I mean, not much actually. There's Team Leads, which is up about 5% or so, but the list really thins out after that. Karur Vysya Bank after the numbers. Not too bad, 2.5% on the higher side. But otherwise, yeah, mid-caps down 1,200 points. And the Nifty is now down about 170 as well. With that, let's move on. In conversation with CNBC TV 18, Rajiv Chhabba, CEO Emeritus of JSW MG Motor India, says that they are planning to launch 5 new cars in the next 15 months. Speaking to Parikshit Luthra, he adds that the company has seen 35% growth in EV sales in just with the 2 EV cars in the portfolio. As we take a break, let's listen into excerpts from this conversation.
I think in MG 1.0, before the JV, we focused on making a great foundation based on good products, technology, good customer experience, community service, and employee satisfaction and good network. I think the team did a good job, and then foundation was laid, and we kept growing every year more than the industry. Now, in this 2.0, we want to grow faster. And the first job of this JV was both the partners wanted to make up on time and approve products. So we already approved 5 products in such a short time of 4 months. And the 3 mass segment products and 2 premium products, and we are going to launch that in the next 15-16 months. So that's a great news. So most of the growth should come from the new products. Also, at the same amount of time, I would say that we are doing pretty well on our existing portfolio, especially the 2 EVs, ZS EV and Comet. I'm happy to say that in the last quarter, where the industry was doing 2-3% more than more similar period last time, our EV sales went up by 35%. So ZS EV and Comet, we are doing almost 2,000 cars a month. You know, which is a spectacular improvement given the condition of the industry. So we are quite upbeat. Yeah, dealers are a little bit nervous because we are going through the expansion program also, right. And then it's a transition period. So, you know, we need to do a better job of taking care of our dealers at this point of time, frankly, because competition is tough, but overall damn good.
All right. So I'm going to ask you, you're speaking about 5 new products that have been approved, 3 in the mass market segment, 2 in the premium. How many of these could be EVs? And when are we looking at the first launch? Would it be as early as this festive season?
So we will start with this festive season. And majority of the products are going to be new energy vehicles, and I will leave it there.
All right, so it could be electric, it could be hybrid, or it could be alternate fuel.
So yeah, so new energy vehicles, you know, include strong hybrids and EVs. So we are working towards that.
What's the sense of the kind of growth JSW MG Motor India are targeting in the whole of FY25 going forward?
See, I think we have a pretty interesting and a very exciting journey ahead of us. When we have done this JV, both the partners are clear on one thing, which is accelerated growth. You know, so we want to increase that in a spectacular way, hopefully, and that's why we are increasing the capacity of the plant right now from 100,000 to 300,000. And when we are saying capacity should be 300,000, it means we need to have the products to fill the plant. So in the next 4 or 5 years, our idea would be to achieve 300,000 volumes. Majority of that in new energy vehicle and with a healthy bottom line. So that's what our plan is.
My final question, what kind of growth in your portfolio do you expect from electric vehicles alone? You're saying that you're just because of 2 cars, you're seeing a 34% growth in your EV portfolio. When you complete FY25, what percentage of your sales will be electric?
I will not be surprised if it is more than 50%.